The yen carry trade. The yen carry trade is all over the news today because Japan crashed 12% last night, which is a monstrous, perverse move for an index. It's an
Yeah.
ungodly move for an index. And U.S. markets today's Monday, August 5th, but it's the evening, and so this probably won't go out for another day or so. So imagine we'll have some volatility here over the next day or two. But as of this morning, we had a volatile day in markets. Can you tell my listeners what the hell a yen carry trade is? Can you explain it in terms they can understand? And then maybe
Uh,
offer your take on what you see happening with U.S. markets?
sure, it's really pretty easy. It's just the interest rates in Japan incredibly low. Let's just say you can borrow at 5 basis points in Japan, and you can take that super cheap debt or money and just buy treasuries. You can buy US stocks. You can buy something that you think is going to produce a higher yield or more appreciation, and you just kind of pocket the spread. And a lot of people have been doing that. It's made a lot of sense. And that type of bet, let's say, works until it doesn't. And it's kind of like the nickels in front of the steamroller. Although
Yeah.
I must say that that yen carry trade, if they're putting that into Nvidia and all these high flying Mag 7 stocks, I mean, they've done extremely well. But when it goes the other way, it goes the other way real, real, real fast. And we're seeing that play out. I don't know that that's the major reason that we're seeing the moves that we're seeing, but I think that's a contributing factor. It's just this unwind to where if you borrow yen and then you buy dollar assets, and all of a sudden the yen goes 10% or 12% against you within the matter of a week, you're like, holy shit. Now all of a sudden, I don't have enough dollars, even though I'm making XYZ in NVIDIA, to pay back that yen, and therefore I've got to hit the bid to pay back that loan. Or you're worrying about the yen appreciating even further, which puts even more of a pressure on you paying back the debt. And then you combine that with the Nasdaq going down, and then it just exacerbates the problem. And then you just kind of get this positive this feedback loop.
Yeah, so essentially what you're doing is you're going, say you borrow, you know, $1,000 worth of yen, and you're taking the at 0%. You're taking the yen, you're flipping it into U.S. dollars, you're converting it at whatever the currency conversion rate is, and
Yeah.
then let's say you're getting 150 yen to the dollar, and say you borrow whatever, say you take the dollar denominated portion of that after you flip the currency and you invest in dollar denominated assets that can give you a yield. Maybe you can get 4% or something on a treasury. And so essentially you're borrowing for zero and you're reaping 4%, except for when that currency conversion goes against you while
By
you're
more than 4%.
right.
Mm.
Exactly. While you're in the second currency, right? And so
Yeah, or if you're in risk assets, if you're in equities, if you could be put in a similar position if the asset you own is going down in price, and you're looking at a chart and you see nothing but air
right.
between the price now and where it could be in a month or so.
Right, and a 12% move in the yen against the dollar, which is it's been over 10%, I think. I think it's like between 10 and 15% the yen has appreciated against the dollar due to unexpected rate hikes for a currency that is a filthy move. I mean, a
Yeah.
10 to 15% move in a foreign exchange pair is it's like a 20 sigma outlier. It almost, I mean, it's more absurd. I think the move in the currency pair is probably more of an outlier than a 12% move in the stock index. That's how bizarre it is for currency. And so,
Yeah, especially in that short of time, Chris.
right. It was like what, 2 weeks or something, right?